You know, people always assume that because I made my name betting against the housing market, I must hate real estate. That couldn't be further from the truth. What I hate is stupidity. What I hate is when people treat their homes like ATM machines. What I hate is when an entire society convinces itself that prices can only go up. But here's what might surprise you. Even without those distortions, even in a rational market, I'd still choose stocks over real estate almost every single time. And today, I'm going to explain exactly why. Let me start with something that's going to sound controversial. Real estate has been sold to the American public as the ultimate wealth-building tool. Your parents probably told you to buy a house. Your friends brag about their property values at dinner parties. Financial gurus on television talk about real estate like it's a can't-lose proposition. But here's the uncomfortable truth. For most people, treating real estate as their primary investment vehicle is one of the biggest financial mistakes they'll ever make. Now, before you click away thinking I've lost my mind, hear me out. I'm not saying you shouldn't own a home. I'm not saying real estate has no place in a portfolio. What I'm saying is that when you actually run the numbers, when you look at the mathematics rather than the emotions, stocks have historically been and will likely continue to be a superior wealth-building tool for the average investor. And I can prove it. Let's start with the most basic principle of investing, compounding returns. Albert Einstein allegedly called compound interest the eighth wonder of the world, and he was right. The problem is, most people don't understand how powerful compounding really is, and they especially don't understand how small differences in annual returns create massive differences in outcomes over time. The stock market, represented by the S&P 500, has returned approximately 10% annually over the long term. Real estate, depending on which study you look at and which time period you examine, has returned somewhere between 3 and 5% annually after accounting for all costs. Now, that might not sound like a huge difference. 10% versus 4%. Big deal, right? Wrong. That difference is absolutely enormous. Let me give you a concrete example. Let's say you have $100,000 to invest today. If you put that money into stocks and earn 10% annually, in 30 years you'll have $1,744,000. If you put that same money into real estate and earn 4% annually, you'll have $324,000. That's a difference of over $1,400,000. Same starting amount, same time period, radically different outcomes. But Michael, you might say, that's not fair. When I buy real estate, I use leverage. I put down 20% and the bank finances the rest. That's true, and leverage can amplify returns. But here's what the real estate enthusiasts conveniently forget to mention. Leverage cuts both ways. Yes, it can amplify your gains. It can also amplify your losses. And more importantly, leverage isn't free. When you take out a mortgage, you're paying interest. You're paying closing costs. You're paying origination fees. You're paying points. All of that comes directly out of your returns. And here's the thing that really matters. You can use leverage in the stock market too. You can buy stocks on margin. You can use options. You can invest in leveraged ETFs. The difference is the stock market doesn't lie to you about what you're doing. When you use leverage in stocks, it's explicit. You know exactly what you're doing. But with real estate, people use massive amounts of leverage and somehow convince themselves they're being conservative. Think about this. If you buy a $500,000 house with a $100,000 down payment, you're leveraged 5-to-1. You've borrowed 80% of the purchase price. If that house drops in value by 20%, you've lost your entire investment. You're wiped out. Now imagine walking into a brokerage firm and saying you want to buy stocks with 80% borrowed money. Your broker would think you're insane. But when it's a house, somehow it's considered prudent and responsible. The cognitive dissonance is staggering. Now let's talk about something that really separates stocks from real estate: liquidity. Liquidity is one of those concepts that sounds boring and technical, but it has profound implications for your wealth and your life. Liquidity simply means how quickly and easily you can convert an asset into cash without taking a significant loss. Stocks are incredibly liquid. If I own shares of Apple or Microsoft or any publicly traded company, I can sell those shares in seconds. I can have cash in my account within 2 business days. I can do this from my phone while sitting on my couch. I don't need to hire anyone. I don't need to negotiate with anyone. I don't need to stage anything or photograph anything or disclose anything. I just click a button and it's done. Real estate is the opposite. It is spectacularly illiquid. If you need to sell a property quickly, you're going to take a significant haircut on the price. The average home takes somewhere between 30 and 60 days to sell in a normal market. In a bad market, it can take months or even years. And that's assuming you can find a buyer at all. This illiquidity has real costs that go beyond just inconvenience. It means you can't respond quickly to opportunities or emergencies. It means you're stuck with an asset even if the fundamentals change. It means you're subject to tremendous timing risk. If you happen to need to sell during a downturn, you're forced to take whatever price the market will bear. With stocks, you have the flexibility to hold through downturns or sell partially to raise cash. With real estate, you're all in or all out. But the illiquidity problem goes even deeper than that. Because real estate is illiquid, the transaction costs are astronomical. When you buy a house, you pay closing costs that typically run 3 to 5% of the purchase price. When you sell, you pay a realtor commission that's usually 6%. So just getting in and out of a property costs you nearly 10% of the value. That means your property has to appreciate 10% just for you to break even. With stocks, I can buy and sell with transaction costs that are effectively zero. Most brokers now offer commission-free trading. Even if they didn't, you're talking about a few dollars per trade, not thousands. Let me talk about something else that doesn't get nearly enough attention: the hidden costs of real estate ownership. When people calculate returns on real estate, they almost always underestimate the costs. They focus on the purchase price and the sale price, and they ignore everything in between. But that everything in between is where your returns go to die. Property taxes, homeowners insurance, maintenance and repairs, homeowners association fees, utilities if the property is vacant, property management fees if you rent it out, vacancy costs when you can't find a tenant, the cost of your time dealing with all of this. These costs add up to somewhere between 1 and 3% of the property's value every single year. And they never stop. You can't opt out of property taxes. You can't decide not to fix the roof when it leaks. You can't skip insurance if you have a mortgage. With stocks, my carrying costs are essentially zero. I don't pay property taxes on my shares. They don't need a new roof. I don't have to mow the lawn or fix the plumbing or repaint the exterior. The company I've invested in handles all of that. They maintain their own assets. They pay their own taxes. They deal with their own problems. And they do it with professional management and economies of scale that I could never achieve as an individual property owner. Here's another massive advantage of stocks that people overlook: diversification. When you buy a house, you're making an enormous, concentrated bet on a single asset in a single location. You're betting on that specific property, on that specific street, in that specific neighborhood, in that specific city, in that specific state. If any one of those levels goes wrong, your investment suffers. Maybe the local economy collapses because the major employer leaves town. Maybe crime increases in your neighborhood. Maybe they build a highway next to your property. Maybe the school district deteriorates. Maybe new zoning laws allow commercial development nearby. Maybe environmental contamination is discovered. You have essentially zero control over any of these factors, and any one of them can devastate your property value. With stocks, I can diversify across hundreds or thousands of companies, industries, and geographies with a single index fund. I can own pieces of businesses in technology, healthcare, finance, consumer goods, energy, and every other sector of the economy. I can have exposure to companies operating in North America, Europe, Asia, and emerging markets. If one company fails, it barely moves the needle on my portfolio. If one sector struggles, the others can compensate. If one country enters a recession, my investments in other countries continue generating returns. This diversification isn't just theoretically nice. It has real measurable impacts on risk-adjusted returns. Modern portfolio theory, which Harry Markowitz won a Nobel Prize for developing, proves mathematically that diversification is the only free lunch in investing. It reduces risk without reducing expected returns. But you can't achieve meaningful diversification with real estate unless you're extraordinarily wealthy. For the average person, their real estate holdings consist of one property, their primary residence. That's not diversification. That's concentration risk on steroids. Now let's talk about what might be the single biggest difference between stocks and real estate, passive versus active investment. When I buy stocks, I'm making a passive investment. I research companies, I analyze their fundamentals, I make a purchase decision, and then I let the management teams do their jobs. I'm not involved in the day-to-day operations. I'm not fixing anything. I'm not managing anything. I'm certainly not getting phone calls at 2 in the morning because something broke. Real estate, even if you hire a property manager, requires ongoing active involvement. Tenants need to be screened. Leases need to be negotiated. Repairs need to be authorized. Property managers need to be supervised. Tax records need to be maintained. Insurance policies need to be updated. The list goes on forever. And if you're managing the property yourself to save money, it becomes a part-time job or even a full-time job. People dramatically undervalue their time. They'll spend 10 hours dealing with a rental property issue and never account for that time as a cost. But time is your most precious resource. It's the only thing you can't get more of. Every hour you spend dealing with real estate is an hour you can't spend with your family, or building your career, or starting a business, or doing literally anything else. That opportunity cost is real, even if it doesn't show up on a spreadsheet. Here's something that really bothers me about how people think about real estate: the emotional attachment. When you own a property, especially if you've lived in it, you develop an emotional connection. You remember your kids taking their first steps in the living room. You remember the dinner parties in the kitchen. You remember painting the bedroom. These memories are beautiful, but they cloud your judgment as an investor. I've seen people hold on to properties way too long because they're emotionally attached. They refuse to sell when they should because they can't imagine someone else living in their house. They overspend on renovations because they're improving their home, not just an investment property. They make irrational decisions because they're thinking with their hearts instead of their heads. With stocks, I have zero emotional attachment. Apple doesn't care about me, and I don't care about Apple. I care about whether Apple is generating strong returns on invested capital. I care about whether their competitive position is sustainable. I care about whether the stock is trading at a reasonable valuation. If the answer to those questions changes, I sell without a second thought. No tears, no regrets, just cold, rational analysis. Let me address something that real estate investors love to bring up: tax advantages. Yes, real estate has some tax benefits. You can deduct mortgage interest. You can depreciate the property. You can do a 1031 exchange to defer capital gains. But guess what? Stocks have tax advantages too, and in many ways they're better. Long-term capital gains on stocks are taxed at preferential rates. Qualified dividends are taxed at preferential rates. You can hold stocks in tax advantage accounts like 401k plans and IRAs and pay zero taxes on the growth until retirement, or never if you use a Roth account. You can donate appreciated stock to charity and avoid capital gains taxes entirely while getting a deduction for the full market value. You can harvest tax losses in down years to offset gains in good years. And here's the thing that real estate enthusiasts never want to admit. Most people don't actually get the tax benefits they think they're getting from real estate. After the tax law changes in 2017, the standard deduction increased so dramatically that most homeowners no longer itemize deductions. That means they're not deducting mortgage interest, they're not deducting property taxes, they're getting exactly the same tax treatment as if they rented and invested the difference in stocks. Let me talk about something that's critically important but rarely discussed: the quality of returns. Not all returns are created equal. $1 of return from stocks is fundamentally different from $1 of return from real estate. Stock returns come primarily from two sources: dividends and capital appreciation. Dividends are cash that gets deposited directly into your account. You can spend it or reinvest it. No effort required. Capital appreciation increases the value of your holdings. You can sell small portions of your portfolio to generate cash without giving up the entire investment. Real estate returns are messier. You might have rental income, but that comes with the headaches I mentioned earlier. You might have appreciation, but you can't access that appreciation without selling this entire property or taking out a loan. And here's the critical point. Real estate appreciation is often illusory until you actually sell. I've seen people who were paper millionaires in 2006 become underwater on their mortgages by 2009. That appreciation disappeared like smoke because it was never real in the first place. There's also a massive difference in how returns compound. With stocks, if I reinvest my dividends, those dividends buy more shares, which generate more dividends, which buy more shares. It's automatic. It's efficient. It compounds smoothly and continuously. With real estate, reinvesting returns is complicated. If I want to use rental income to buy more property, I need to save up for a down payment. I need to qualify for another mortgage. I need to find another property. I need to go through another transaction with all the costs and headaches that entails. The friction is enormous. Now, I want to address the big short elephant in the room. Yes, I made a fortune betting against the housing market. Yes, I saw the 2008 financial crisis coming when almost nobody else did. But that doesn't mean I think real estate is always a bad investment. What I think is that real estate is usually an inferior investment compared to stocks for most people in most circumstances. The housing bubble happened because people believed real estate was a can't-lose investment. They believed prices would always go up. They believed you could buy a house with no money down, no documentation, no ability to repay, and somehow that would work out fine. They were wrong, and millions of people lost their homes and their savings because of that delusion. But even without the bubble, even with rational pricing, real estate still has all the disadvantages I've been talking about. It's still illiquid. It still has high transaction costs. It still requires active management. It's still a concentrated bet. It's still tax inefficient for most people. The bubble didn't create these problems. It just exposed them in the most painful way possible. Here's what really matters. Over the long run, stocks represent ownership in businesses, and businesses create value. They innovate, they improve productivity, they find ways to serve customers better, faster, cheaper. That value creation shows up in stock prices. Real estate, on the other hand, is fundamentally a commodity. A house built in 1970 doesn't create more value in 2020. It's the same house, just older. Any appreciation in value comes from inflation, population growth, or changes in the local economy, not from the property itself becoming more valuable or productive. Think about it this way. If you'd invested $10,000 in the S&P 500 in 1980, you'd have over $1 million today. That growth came from companies like Microsoft and Apple and Amazon, creating enormous amounts of value for customers and capturing some of that value for shareholders. If you'd bought a house in 1980, it would be worth more today primarily because of inflation and perhaps some local factors. The house itself didn't create anything. It just sat there. This gets to the heart of why I prefer stocks. I want to invest in value creation, not speculation on scarcity. I want to own pieces of businesses that are innovating and growing and compounding their earnings. I don't want to own an inert asset that requires constant maintenance and generates returns primarily through financial engineering and leverage. Let me talk about something that's especially relevant today: interest rate sensitivity. Both stocks and real estate are affected by interest rates, but in different ways and to different degrees. When interest rates rise, it generally makes borrowing more expensive, which can slow down the economy and affect asset prices. But here's the key difference. With stocks, you're not personally borrowing money. In most cases, if interest rates rise, it might affect the companies you own, but it doesn't affect your personal finances unless you're using margin, which most investors don't. With real estate, if you have a variable rate mortgage, rising interest rates directly increase your costs. Even with a fixed rate mortgage, rising rates make it harder to refinance and harder to sell because potential buyers face higher borrowing costs. More fundamentally, real estate is extremely sensitive to interest rates because most buyers are constrained by what they can afford monthly, not by the purchase price. When interest rates double, the monthly payment on a mortgage can increase by 50% or more. That means buyers can afford much less house, which puts downward pressure on prices. We're seeing this play out right now. As rates have increased from their historic lows, stocks are more resilient because they're not as dependent on financing. Yes, higher rates can affect valuations, but well-run companies can adapt. They can adjust their capital structures. They can focus on different growth strategies. They have flexibility that a piece of real estate simply doesn't have. Here's another critical advantage of stocks. They scale. If I want to invest $10,000 or $10 million, I can do it with stocks. The process is exactly the same. The costs are the same as a percentage of the investment. The effort required is the same. With real estate, there's a huge difference between investing $10,000 and $10 million. With $10,000, you can maybe scrape together a down payment on a small property in a mediocre location. With $10 million, you can buy multiple premium properties or even commercial real estate. But the process is completely different, and the effort required increases dramatically. This scalability matters because it means stocks work for everyone. Whether you're just starting out with a few $100s or you're managing a multi-billion-dollar portfolio, stocks are accessible and efficient. Real estate, by contrast, has high barriers to entry and really only works well if you have substantial capital to deploy. Let me address one more argument that real estate people love. The idea that you can see and touch real estate, that it's tangible in a way that stocks aren't. This is pure psychology, and it's actually a disadvantage disguised as a benefit. Yes, you can touch a house, but you can also touch a stock certificate if you really wanted one. More importantly, the fact that you can touch something doesn't make it a better investment. This tangibility bias causes people to overestimate the value and security of real estate. They think because they can see it and touch it, it's somehow safer or more real than a stock. But a stock represents a real ownership stake in a real business with real assets and real cash flows. Just because you can't touch it doesn't make it less real. In fact, I'd argue that a diversified portfolio of stocks is more real and more secure than a single property because it represents ownership in hundreds of actual operating businesses rather than one structure sitting on a piece of land. Now, I want to be clear about something. I'm not saying real estate is always a bad investment. There are circumstances where real estate makes sense. If you're a professional real estate investor with expertise in the market, access to good deals, and the time and energy to actively manage properties, you can absolutely generate strong returns. If you can buy distressed properties at significant discounts, fix them up, and sell or rent them profitably, more power to you. But that's not what we're talking about here. We're talking about the average person deciding whether to put their savings into stocks or real estate. And for that person, in that scenario, stocks win almost every time. The math is clear. The evidence is overwhelming. Stocks have generated higher returns with lower costs, better liquidity, easier diversification, and far less hassle. The real tragedy is that millions of people have been sold a lie. They've been told that owning a home is the path to wealth. They've been told that renting is throwing money away. They've been told that real estate is the safest investment you can make. None of this is true. Renting and investing the difference can leave you much wealthier than buying. Real estate is actually quite risky when you account for concentration, leverage, and illiquidity. And the path to wealth is owning productive assets that generate growing cash flows over time, which is exactly what stocks do. I've spent my career looking for market inefficiencies, for places where conventional wisdom is wrong and the math tells a different story. Real estate versus stocks is one of the biggest inefficiencies in personal finance. People make emotionally driven decisions based on social pressure and outdated beliefs, and they pay for it with lower returns and higher stress for decades. If you take nothing else away from this, remember this: investing is about mathematics, not emotions. It's about expected returns and risk-adjusted performance, not about what feels safe or what your parents did or what your friends are doing. When you run the numbers objectively, stocks come out ahead. That's not my opinion. That's what the data shows over decades and across different market environments. So yes, I prefer stocks over real estate. And it has nothing to do with the big short. It has everything to do with the fundamental characteristics of each asset class. Stocks are more liquid, more diversifiable, more scalable, more tax efficient, less costly, less time intensive, and historically higher returning. They allow me to own pieces of the world's best businesses without having to unclog toilets or argue with tenants or worry about the roof leaking. That's not to say you shouldn't own a home if you want to live in it. A primary residence can make sense for lifestyle reasons, for stability, for the freedom to modify your living space. But don't confuse a consumption decision with an investment decision. If you buy a house to live in, you're buying a place to live. You're not making an investment in the same way that buying stocks is an investment. The bottom line is this: I allocate my capital to where I believe it will generate the highest risk-adjusted returns over time with the least amount of friction and headache. For me, and I believe for most people, that means stocks, not real estate. The market has proven this out over and over again. The only question is whether you're willing to look at the evidence objectively or whether you're going to keep believing the comfortable myths that everyone tells themselves about real estate. I've made my choice. The data supports it, the mathematics supports it, the historical evidence supports it. Now you have to make yours.